Morning, everybody. It's Aloha Friday here in Playa del Rey, California, where I'm coming at you from. Dr. K, you're out there?
I sure am.
And let's see, what do we got going on today? We got S&P rebalancing, which adds to a little bit of the funky action in the market. And I think yesterday's gap down opening, which there were a couple of stocks, like I saw Michael Kors drop down to 51 around the opening. I was watching Zillow, broke down to like 43.68 on the opening. Those all look like spots to buy the stocks, and then this morning you gap up, and I have to tell you, just for the purpose of fair disclosure, stock like Coors, I unloaded into the gap up into 56. I don't really think you're in a momentum market, and I still think that 20 million share offering overhangs a little bit here on the stock, so I'd rather take some profits and kind of hang out. And for the most part, I think that's what you're seeing in the market. There's a few things that are moving nicely. And the gap up in Coors is nice to see as well, and the upgrade in or raising their numbers. But I think the way I operate, as you all know, is very aggressively, and so I'm taking a big 100% position in Coors around 52. I'm going to take advantage of a gap up on a day like today to sell some into it. I also think some of the metals moving up today probably could have been sold into, because basically what I see here going on is just the market's still consolidating. If we look at the NASDAQ composite, take a look at it here. Whoops. See if I can type today. You got a nice gap up here, but you're still within this range where you could just continue going sideways. And if the gap up today is partly due to the rebalancing the S&P indexes, it could be, and I'm not going to say this sinisterly, but it could just be something that's manufactured in the short term. But for the most part, you're seeing a lot of stocks. Leading stocks are holding up, moving sideways within their bases, and trying to just continue building constructive patterns. And we got to remember the market's been up pretty far. A lot of bears are turning into bulls here. So I could see maybe going sideways for a while. Also, the situation with QE3, that's all out of the bag. I guess the ECB, that's pretty much out of the bag. Is that right, Dr. K?
Yes.
Yeah, so so it's all known news, and a lot of this rally was probably predicated on discounting that. So now I think what you're looking for is what may be the next catalyst for the market, one way or the other. And the market doesn't have to be negative or bearish or bullish here or whatever. It could just go sideways for a period of time, and it might make sense given that we have moved higher. But I think if you're running core positions in stocks that continue to act okay, then you're probably just sitting. If you're a maniac like me and you're very aggressive, I will unload my outlier portion of my position and get back down to a core position on these big spikes to the upside that you see in some of these stocks. So that's really kind of where you're at. There's nothing really fancy here, nothing really tricky, and that's kind of why we've been waiting all week to have a webinar, because we haven't seen that much that needs to be done necessarily. And anything out there that really looks like you need to come in aggressively. I want to answer a couple questions just really quickly, just because we're getting these right now before I move on. But someone's asking, what do we think of Q-Core? And I think if you understand how we approach the market, it would seem to me that you would understand that we're not even interested in the stock. That kind of a break is not something you want to be in. If you were buying the stock thinking that you're looking at a nice cup with handle here, and I haven't trusted this stock for a while. The action in it has been very erratic, and there have been some questions with this drug Acthar, and so you see this break on news that Aetna, I guess, is no longer going to be covering payments for the drug, but some are saying that's not true. That is true. I don't really care. I'm just looking at the technical action of the stock. You get this reflex bounce, and if you look at something like this and you want to buy it because you think it's cheap, I think you've got your head, as Bill O'Neill would say to us, you've got your head screwed on all wrong, because it's not something you even want to bother with right now. So there's nothing really to think other than to think nothing, and that you just want to stay away from it. Now I know there was, Dr. K, you had mentioned to me yesterday that you thought you saw a pocket pivot in this the other day, but you refrained from it, I think for a lot of the same reasons I'm talking about, which is that the pattern is not really that sound looking. It looks a little funky, looks a little off kilter, and I think that was your thinking. Is that correct?
Yeah, there are a few too many defects in the pattern, so it didn't warrant mentioning.
Yeah, so we didn't really go for it. I think there were some questions earlier in the day, and you notice, I think that the day before this occurred on Wednesday, the break. today's Friday, and you're trying to rally up here. But this day, you can see how that also reversed. And the other thing is, when you got that kind of a cup formation, you form a handle. It's about 1 week long, and it's probably a little too short, you know, given the steepness. The only stock I've seen do that and actually work has been Racks, which came and built this big cup and then this little tiny handle here, which I don't even think shows up on the weekly chart. And it's managed to move higher, much to my chagrin, because I made a few bucks off of it running up to 60 from this level, and then it just kept going without me. But, you know, that happens sometimes. I'm not going to worry about it. It's all spilled milk at this point, but at least I made money in the stock trading it. But I've never really seen a stock just continue like that. Usually when it comes straight off the bottom, it's got to take some time for a couple of weeks to at least consolidate that, but it's really continuing to move higher. And you know, that's just a rare occurrence. When you see it in something like this, you know, Cinderella only comes once, and I think that was the case with Racks, certainly not the case with Questcor Pharmaceuticals, and nothing's done. So I wouldn't touch that with a 10-foot pole or a 20-foot pole or whatever else I touch things with. In any case, looking at the metals, you got silver on the SLV. Again, you know, you had a sharp run up. All of this based on QE, and the interesting thing is that the metals, the precious metals, had a bigger move last Thursday than the market did, and than a lot of stocks did as well. And really, the metals have been the place to be rather than stocks, even though there are some stocks that have moved up and have acted pretty well with 10-15% moves. This thing's had a much better move, silver outperforming gold. I think the move from here to here is about 23%, whereas gold's move has been more like 9-10%. Am I right there, Dr. K? Can you check my calculations?
Yeah, that sounds roughly right. Sure. I mean, we just know that they're moving aggressively to the upside, and that's great. And so, you know, if you're in any of the leveraged ETFs that reflect gold or silver, you're doing pretty well.
Yeah, and right now, if you're looking at, and what I do actually, I run a pullback sound at the 10-day, I get heavy, and then I've sold into the moves above 60, and that's where I didn't really think today's move was going to pan out, and it hasn't so far. But looking at it coming down into the 57 area around the 10-day might be a buy point again, but you might wait. You're going to have to wait for the next buy point in the stock. But I have one question for you, Dr. K. On this pocket pivot, this is a big pocket pivot buy point. Do you consider where silver is trading right now to be within range of that pocket pivot last Thursday?
No, it's still, to me, extended because, you know, silver's made a big move overall, and that pocket pivot, silver had a huge move to the upside. So, in other words, you wouldn't want to be buying that pocket pivot close to the high of that trading range, and that's about where silver's trading right now. So to me, it feels a little still a little extended. You could have bought this a few days ago when it actually did retrace about half that move. Yeah,
right.
That would have been acceptable. And again, this is a reflection of you know, what most people's risk tolerances would be.
Right. I think for now you're just waiting for the next buy signal, or either that or a nice pullback if that's what you want to try and buy into. But you know, they're acting okay, so we'll hold a core position here and hang out and see where it goes. But what I've noticed is it's actually been the best performing thing that we bought, although we've had some things act pretty well. LinkedIn has been a good stock for us, but that's mostly because we were buying in on these pocket pivots around the 50-day moving average, and you could buy again on the breakout. And of course, stock's holding up pretty well. We were watching for here along the 10-day moving average. As you pull in, not a lot of volume pulling in today. Possibly a continuation pocket pivot off the 10-day moving average. So that really would be your next entry point for LinkedIn. I think social networking has got to be a spot where there will be growth, and I think LinkedIn is one of the companies showing that they can grow earnings pretty well in their particular space. And they're now starting, I think, to charge companies or offering their data that they have on their members in terms of employment profiles to companies, and they actually have a little gold mine there, it appears, and I've done some research on this. It looks like they've got a lot of potential, especially internationally, so the pattern confirms it. So it's definitely a stock, I think, to look at going forward if we continue in a bull market phase. And of course, getting in here along the 50-day, the advantage of the pocket pivot is quite evident, particularly for a stock that is as volatile as LinkedIn can be at times. But notice how, you know, it used to be choppy here. It's a little more coherent. And I think you could see, we talked about this several times, you can study the base. And neither Dr. K or I consider the shapes of bases and, you know, the percentage moves within the base and all these other parameters that people try to define the shape of the base with. We don't really consider that important. And in my experience, just trying to figure out on a weekly basis what's going on. Are you seeing overall net accumulation or distribution within the weekly pattern, as well as understanding what institutions are doing. And of course, I've seen a lot of institutions moving into LinkedIn over the last quarter. I'll be interested to see what the next numbers look like. I don't think they're out yet, the September quarter institutional ownership numbers for mutual funds, hedge funds, pension funds, whatnot. But a lot of the Fidelity funds were moving into this and increasing their position. Now, interestingly, Zillow, we saw that Trulia yesterday, TRLA came public, and they're losing money hand over fist. Zillow actually is making money. And on a weekly chart, you can see this cup with handle. Let me spread it out a little more. I can make it look less volatile that way. But it's pretty erratic. You know, you don't see a lot of closes. You do get a few tight closes in here along the 10-week moving average, but it doesn't really hold that line. It's very erratic, but notice how now it is breaking out and you are seeing some volume. But the movement still is fairly erratic, and you can look at the daily chart. It's pretty wild. And like I said, yesterday you got down as low as 43.68 before turning around and rocketing up to new highs, actually. And these are actually new closing highs because the day that Zillow came public, I think it closed down here, which again proves our point that you never want to buy stocks on the day of the IPO unless you are a greedy fool. And apparently there are a lot of those out there. Like all the people who tried to buy Facebook. But you know, this one's acting okay too. I don't really care for the Trulia because the earnings are negative, but those stocks are interesting, I think. I would like to see Zillow's pattern become a little more coherent. So, but that's another stock that I've liked. And looking at Coors, you see, I always think of Coors here, but you can see the gap up here. It is a viable gap up, but it's kind of occurring in a weird context, like we were talking about, with the 20 million share offering still yet to be priced. And I was actually surprised when I saw the news after hours on Coors yesterday. I thought that you might also see them announce that they had priced the IPO at 53 or 54 bucks, but they haven't. So we're still waiting to dump that, and you can see it's coming in. So obviously, if you don't hold the low, the low 54.40, I guess it's not really holding up. But you can also see you're running into some resistance, and I think that makes sense, given that you still have the secondary offering to come out. So, other stocks that look okay. Apple has been trying to get through the 700 level. It is running out of gas. There's not a lot of volume. Now, today you're probably going to see more volume because of the S&P rebalancing, but it's hovering around the 700 level. And remember, Livermore's, as I call it, Livermore's century mark rule. But if you read Reminiscences of a Stock Operator, he talks about handling a railroad side, no, Anaconda copper, and I think at that time Anaconda was going up through 300 for the first time. Apple is going up through 700, and the premise behind Livermore's rule is that a stock should continue moving sharply through there. So far, Apple is, found a little resistance there. Maybe it is trying to get through there, maybe it will. But at this point, a lot of institutions have owned the stock for a long time, and you're kind of seeing a lack of buying interest up here in the volume. So just keeping an eye on that. If you own the stock, it still looks okay. My tendency is to cut back on it up here and then wait and see if we get some kind of thrust off of this 700 level. And remember, if you're $4 ahead, above rather the 700 level, that's not about 0.5%, a little more. So it's not like it's a big move. So don't get carried away with points. I was on a radio interview yesterday with some guy, and I guess he didn't like my comments about penny stocks, and where I thought they're mostly just junk, and you're never going to make any money investing in penny stocks. And he made a very interesting point that he seemed to think validated why you should buy, $1 or $2 stocks, and that was that your loss is limited. And I thought to myself, what are you talking about? If you put X amount of dollars into a stock and it goes to zero, well, you've lost 100% of your money. So I don't understand how that limits your loss. He's obviously thinking in terms of points, and I think that's where people go awry. You have to think in terms of percentages. And yeah, it's great if a $3 stock goes to $5 and you own 100 shares. Big deal. You made $200. And to really make money, you got to own a significant position. And if you do, if that thing drops 50%, you're going to lose 50%. I don't understand the logic, but we can reverse that and apply it to Apple. 10 points on Apple is a little over 1%. It's not really that significant of a move, so you got to think of it in those terms. So I'm just kind of watching how it acts around the 700 level. And so far, so good. But it could go sideways here for a period of time. iPhone 5 sales are coming in very strong, but they don't seem, aside from this 3-day move up, we had a couple of gaps in the pattern, you're not seeing any really big volume coming here at the 700 level. Now, Dr. K, I got a question for you. Is this move here last I believe it's last Thursday. Is that a viable gap up?
No, not in the context of the pattern, since it tends to do that quite a bit. I mean, a viable gap up really should be, you should be able to immediately eyeball it and say, yeah, that's certainly a viable gap up. And you can see in Apple's pattern, it's done that a number of times.
How about not viable gaps. Expedia, this is one we own actually, and it's up, gapped up today. You had a pocket pivot in here, you had a pocket pivot in here. Where was that? Right here and here. So you had a couple of buy points in here to get in on this thing. It's gapping up to the top of the base on an upgrade. And so far, is that running enough volume for a pocket pivot? Well, it is running, not a pocket pivot, but rather a viable gap up, and it is actually. But I don't think I'd buy it up here.
And we mentioned this a couple days ago to members, so anyone who got on board is in the money. And yeah, I was thinking, well, should we mention this yet again? But we've already mentioned it, just 2 days ago, so it almost becomes a little bit redundant to just keep mentioning these names over and over again.
And I think you're in a better spot if you bought it off the pocket pivots like we did, and you're up today and you're kind of sitting there. I think, like I was saying earlier, I think you're more in a mode where you might back and fill a little bit. So I'm not that excited about buying momentum or Momo moves, as I call it. What I like buying are pullbacks right now, given the position of a lot of stocks. If they're coming in into logical areas of support. Let's see, going through my list here, what else do we like here? Onyx has been a great biotech. It's probably been biotech of the week last week. Sharp move, breakout. We told you about the pocket pivot here. So you get in early, and then you got the breakout to add on right here, which also was a pocket pivot, and it's acting well. But you can't buy this unless it comes back under, say, 83, 82. The closer to 80, the better. Bring you back to the 10-day moving average, I suppose. But at this point, it's extended, but it's acting well. And another one that we've liked, Regeneron, it's holding its breakout, but it's pretty much acting as it usually does. Remember, we had some pocket pivots. You had this big pocket pivot here, and I think you had one here, in here. Where was it? Yeah, right here. And again here. And, it moves up, but it's backing and filling. It's acting okay within its base, cup with handle, pulling back. I would see if it tests the 10-week moving average coming up through 141. I think on that pullback, that might be a spot to buy shares if you're interested in coming into the stock at some point. But for now, this is just going sideways and hanging in there, so nothing really too exciting either way. If we look at, say, Amazon's had a nice move as well. I saw an article earlier, someone saying, has the move to the downside in Amazon begun? And I think it's an interesting premise, but I don't know, flip a coin. Will my aunt grow testicles and become my uncle? I don't know. It seems to be at the same premise that you're working on here based on today's action. You're trading a little heavier volume, but again, we have S&P rebalancing, so a lot of stocks are going to have some exaggerated volume. So, but it's acting okay, and you've seen that in some of these bigger NASDAQ stocks. Priceline, though, has slowed down a little bit. Had a pocket pivot coming up to the 50-day. You've seen Intuitive Surgical trying to hang out above its 50-day, and I believe you had a pocket pivot here coming up, tested the 50-day, and it's moving up. I don't know if these are trying to build bases or what, but not really something I'm interested in buying. I think Ross gets into something more like this because he feels that he's got a quick stop out here if it doesn't hold the 200-day, because now you're coming above the 200-day. But the interesting thing to note here is that the 10-week line on Intuitive Surgical is crossing below the 200-day line, which isn't necessarily positive, but you see how this one goes. But you have seen, and my point is simply that you have seen some strength in some of the bigger NASDAQ stocks, and that has actually helped the NASDAQ, I believe, outperform. That has been the outperforming index right now, hasn't it, Dr. K?
I believe so, yes.
Meanwhile, I don't know if this is troublesome or not, Dr. K. I haven't had a chance to talk to you about this, but you've seen... Whoa, what happened? Okay. Still there?
Yes.
You've seen that the transportations and the rails just get pounded. Yesterday, Norfolk Southern came out, and I think they guided down in terms of volumes or something like that. And that just, you already started to see the rails weakening, and you can go across the board. KSU, Kansas City Southern, also getting hammered. NSC was the one that got hammered yesterday and took the whole group with it. I'm not sure if this is trouble for the market. Now, we talk about divergences and whatnot in the transportation index versus the Dow, And of course, you've seen that, and you're trying to move ahead. This is a weekly chart. If you're looking here now, this is what you're having, this breakdown. But I am a little bit troubled by the rails breaking down like that. That seems a little bit excessive to me. And if it is indicating that we're going to see some sharp and severe economic slowing, then I would expect that it will show up in stocks eventually. But I think that you can wait and watch your stocks and wait for your stocks to confirm or start to break down to confirm this sort of economic weakness coming down the pike, if in fact that's true. But don't necessarily.
And it could also be that QE just comes in and acts as a cushion against economic slowing. So you might see that, as we're seeing the trannies are breaking down, but meanwhile everything else is holding up because the big money is basically saying we're going to continue to fuel the market and buy it up, kind of like we've seen in QE periods. This
is what we can argue about then here, is that if you're saying QE might prop up, what economy is going to prop up? It certainly hasn't caused the U.S. economy to exhibit any sort of strong growth. It's just kind of muddling along. As long as they keep pumping money into the financial system, we see stocks rise, we see metals rise. But will it actually?
Well, actually, I should actually more specifically say that QE will prop hard assets like stocks, like precious metals, like real estate,
right.
But it's not going to prop the economy. The economy is going to remain sluggish to morose, potentially recessionary in the U.S. I mean, it is recessionary here in the U.K. and in Europe. And also, the job creation issue. Jobs have been, we've lost something like 2 million jobs since 2008. Obama can talk rings around, how he's created 1 million jobs or whatever he's done, but the fact of the matter remains that jobs have been lost, despite all this QE that's been pumped into the system.
Right, and despite this baloney being pushed by Obama that he's created 4.5 million jobs. So how do you know Barack Obama's lying? His lips are moving. Let's see if anybody gets upset by that. Is NSR a pocket pivot? Well, not right now. If it traded higher volume than these two down days here, then I guess it would be. So
it will be if it hits. It needs 474,600.
Right.
And,
can you talk about the volatility in? I'm sorry, Dr. K. Can you talk about the volatility in SLV and AGQ? Well, I'm not sure what there is to talk about because we already know, and we've talked about this many times, that we already know on a historical basis that silver tends to be 2 or 3 times as volatile as gold. So you already know that, and that works great on the upside, but you're also going to get sharper pullbacks in silver. So, how do you handle that? Well, you measure your position, or if you're a maniac like me and you like upside volatility and you can play it, keeping things close to the vest, then that works in your favor. So, but that's just the nature of silver versus gold. And I think part of that is due to the fact that the silver markets are less liquid than the gold markets. So, I should mention something else. Somebody emailed a question in. I guess another report that I wrote on the internet, I had one chart. I guess it had a 5-day exponential moving average, and they asked me to discuss how I use a 5-day moving average. And I got to tell you, don't overthink what you see on our charts. When we discuss using the 10-day, sometimes the 20-day, the 50-day, and the 200-day moving averages, those are really the moving averages we rely on. Sometimes in shorting, or even with commodities, I use a 65-day exponential. But when you see something on one of my charts, it may just be there because somebody mentioned something to me, and I remember I know a guy who trades options, and because options are so volatile and he's playing a lot of quick moves, he uses a 5-day exponential, and so I just put it on one of my charts just to see what it looks like. But I can't tell anything from a 5-day exponential. That's such a short moving average. I mean, I think it's a day trader's moving average, so I don't use it. So, but I always think it's interesting that something shows up on my charts. Maybe I'm just going to start putting weird things in my charts just to see what kind of questions we get. But all that is to say is I don't use a 5-day exponential moving average in my trading. Okay. Let's look at Facebook. Facebook, you had this sort of weird gap up, pocket pivot, bottom fishing move, whatever you want to call it. And that's actually worked. And I've been trading this off and on, and you had another one 3 days ago coming up to the 50-day. And this is what Facebook looks like on a weekly chart. That's about as butt ugly as you could possibly be if you were a chart. Fortunately, none of us are charts. We're just human beings. I don't know if humans get this ugly, but this chart certainly looks pretty ugly. I don't know if this is the world's ugliest, deepest double bottom or what it is, but right now, if you're trading this, you're probably playing for a move up into the 25, 26 area where you might find some resistance in this gap. I don't know. But I do think it's interesting that it's turning. And right around here, when everybody was predicting $9 and $12 a share for Facebook, it's turning. But, you know, I think I've been watching this thing trade intraday, and I think there are some institutions taking some positions in here. And there is some talk that Facebook is experiencing some growth with their mobile advertising. We'll see. Do big traders run the shorts in the metals? Big traders, like you guys over 6'2"? I have no idea. Dr. K, any answer for that? I don't think so. I know that there are what are known as the commercials, and those are the big buyers and sellers in the metals and also all other commodities. And obviously, anybody with a lot of money can push things around any way they want to. I don't have any intimate knowledge of them actually doing that. Do you, Dr. K?
When you say them, you're talking about the big money institutions?
I guess, you know, do big traders run the shorts in the metals?
You know, I just don't really. I wouldn't say so. I mean, it could be, but you know, the effective volume indicator is pretty good for looking at where the big money is flowing, whether they're selling or buying.
Yeah.
And of course, you know, it's no indicator is infallible, but it's a useful tool. And I would say, yeah, I mean, obviously there is big money out there that does determine the direction of a lot of these names. So I guess the short answer is, yeah.
Well, in any case, yeah, the short answer is, yeah, the big buyers influence pretty much everything. You know, what makes a leading stock go higher is big money moving into it. But, you know, I don't know if they deliberately manipulate the thing by trying to jam it down the shorts' throats, you know, every time they come in. I do think that there has been a lot of bearishness in the metals, and you may recall, if you follow some of the commentary out there, which sometimes I do just to kind of get a contrarian a sense of what's going on, and everybody was bearish on the metals. You know, I remember some guy sending an email out saying that the metals gold is going to be a great paperweight. The funny thing is, I actually do use a 10-ounce gold bar as a paperweight. So, and I bought that when gold was around 286, I believe. And it's been a great paperweight ever since. But you know what? What makes it an even better paperweight is the fact that it was a paperweight that I bought for $286 an ounce, so $2,860, and it's now worth almost $18,000. So I guess gold does make a great paperweight because it's the only paperweight I know of that keeps going up in value. But you know, that's kind of, you get this kind of smug commentary, and you know, I should know smug commentary better than anybody since I'm full of it myself most of the time, anyways. But you know, when everybody's bearish on the metals, that's usually the time that you want to be buying them. And when Fox Business News has stopped asking me to come in and talk about the metals, then you probably know that's the time to buy them. Of course, when they're up, they want me to come in. I was scheduled to come in and talk with Stuart Barney this past Tuesday, but I got bumped because of all the great campaign news about what Mitt Romney is saying and what Obama is saying. And you know what I think they should do? I think they should just merge the two guys into a composite candidate that we can call Bit Obamney. And this candidate can cater to all the delusions of voters on either side of the aisle. But it seems like, you know, what's news these days, it seems to be like what these guys are saying, and I'm really more interested in what kind of policies are going to get us out of the quagmire that we're in. Because remember, you have $16 trillion on a cash basis is what the U.S. has in debt, but the reality is if the U.S. did their books the way the SEC requires companies to keep their books, which is on an accrual basis, the U.S. has somewhere north of $70 trillion in liabilities on its books, but nobody talks about that. It's shuttle flyover Friday. That is true. They're coming into LAX, and I was hoping to get out there. Did they already land? I haven't been really watching the news on that. I don't really have time to go out there. Anyways, I also noticed they shut down all the streets around the airport, which is not too far from my neighborhood, and that they will be trundling the shuttle down the street sometime today, and I'm sure a lot of people will go to see that. I think I'll just wait till they have it implanted at the California Science Institute, which is at the museum near the Coliseum in downtown, actually in South Central LA, and check that out. But somebody notes that. But I think I'll go check out the space shuttle when they've got it set up over there. Let's go through some more questions here. Could you talk about adding to leaders and taking from laggards in an uptrend? Could you also mention time stops in this regard? Well, I'm just going to say I use time stops, but they're not used in that regard. What I do when I'm talking about time stops is that I will take a big position in something, and because I always want to keep my risk, if I'm going to take a massive position in something, I want to keep my risk to a minimum. I will give it only a few days, maybe even less than that, to do something, or else I'm just gone. Because my theory is that it should start to move very quickly. But I'll let Dr. K talk about this, which is, Dr. K, could you talk about adding to leaders and taking from laggards in an uptrend?
Well, I keep it pretty simple. I mean, the sense that I have rules that I follow. If a stock is a true leader, it's going to give a number of pocket pivot buy points on the way up or buyable gap ups. And if it is one of those stocks that obeys the 50-day and not the 10-day, then when it trades around the 50-day, I watch it carefully, and if there's a volume dry up around the 50-day, I might add to my position there. I don't need to see a pocket pivot. So there's lots of possible ways to add to your position, and that means you don't have to start with a big position, especially in a choppy market where you might get taken out on that first initial position. But as you accrue position size in that stock, your average cost should be lower and lower relative to where the stock is trading. So you have added financial profit cushion in that name, which gives you added psychological cushion and strength to trade the name properly and not get scared out of the position should the stock take a tumble for a couple days, as leaders will often do. No leader goes up in a straight line, and the idea is to be able to have a very firm hand in that position so you can ride it all the way up and capture the fat part of the curve. Now, obviously, if you have a violation of the 10-day or the 50-day, as per those sell rules or your own sell rules, you've got to adhere to that, and you've got to take, maybe I typically will sell half of my position if the stock is either not keeping up with the market or with other leading stocks, or perhaps if it does have a 10-day violation or 50-day violation, I usually sell the whole thing out. And I can always redeploy the capital in that same name if it should prove itself sometime later.
Yeah, and if I may interject a shameless pitch for our upcoming workshop at the Traders Expo at Caesars Palace in Las Vegas on November 16th, we will actually be conducting a full 3 hours of trading simulations, just picking out leading stocks over the past year, recent examples, and going through them day by day, and just going through the whole process. And so for 200 and what is it, Dr. K, 270 something bucks, if you guys want to come out to Vegas and have a drink with us and come and check out the workshop. We're going to be there for a couple days, and I think that might be helpful in understanding how we would handle positions in real time, and a methodology for handling them that's fairly coherent, we think, utilizing pocket pivots, Bible gap ups, constructive pullbacks to 50-day moving averages and whatnot, along with the 7-week rule to manage positions and build positions in a bull market. So hopefully some of you will decide to come out, and we do get a pretty good crowd. I know that we are the top draw when we go to these things now, which is interesting. And so the Money Show and Traders Expo, put on by the same company, they really love us. But you know what, Dr. K, we never got a check for our cut on the last one we did in May. You know that?
Yeah, it was actually, it always slips my mind, this stuff, but I figure, you always get back to me on stuff like that when.
Yeah, I haven't seen you. We're going to have to go ring their bell, because I know some people.
Yeah, just drop in an email, I guess, and just, it sounds like they could have slipped up, or there's some.
They're just trying to rip us off. I don't know. I think the one, we had a huge crowd last November, about 150 something people, 160, and we made all of 2,700 bucks off of it. So, I don't know. We're not trying to make money, I guess. It's just kind of fun to do. Somebody asked, Sally Beauty Holdings is, I don't know, I'm not a buyer. I don't really like it. What is this? This doesn't even hit my radar screen, so I'm guessing it's really thin. Yeah, it doesn't trade too bad, but I mean, it's okay, I guess.
It's got a gap down there in that
pattern. Here's the problem, though. Yeah, and 6% sales growth, not really. It's a retail operation. If they're a good retail operation, they should be showing strong sales growth. They do seem to do a pretty good job of leveraging their sales growth into decent earnings, and there is pretty good sponsorship, but I don't think it's really a stock I'm interested in. I know.
Yeah, and a lot of funds actually sold this thing a couple quarters ago. It went from 536 funds down to 429. So yeah. There's too many defects. Yeah,
they've been coming in lately. I mean, even Ulta Salons, which I guess I would throw into this group here, it's not really holding this viable gap up at all, and that's not really constructive. So I'm not sure this is where I really want to be right now. So I'm not sure I'd really be into it. Tractor Supply, another retailer, has built a cup with a handle, but I'm not really a buyer here. You had a pocket pivot type move right here, I believe it was, somewhere in here. No, I guess not. Just this gap. It's kind of, this is kind of nondescript too. So I'm not a buyer. There are no buy signals in it. It's trying to build a handle, and that's about it. Somebody says, is this the time to invest in Biopharma and Halo? And I don't know what you mean by invest. You mean buy the stocks? I think there's some news on this one. Doc, what's your take on this one? This one strikes me
I don't
as
like that gap down. I hate stocks that have these massive gap downs, especially when they're biotechs, and that means it's pretty much off the table for me. This would have to trade for a number of months, really redeem itself, then maybe I'm interested again. Or it could have some news that creates a huge viable gap up of some sort, that really turns the tables up for the company. Then I might get interested. But right now, there's not enough.
Yeah, and here's Halozyme. I don't know what would make anybody want to buy that stock. And you get a couple of gap downs. It's really just in a big, ugly,
gun to your head
pattern I've never seen. So, we're not buyers, unless you know something about the story. Would you discuss more why you are selling into a BGU versus an opt-out to existing positions? Well, I talked about cores, and mainly it's because they got a secondary, 20 million shares coming out, and you get some resistance here. You could end up adding, but I'd rather wait and see what happens after the secondary. So what I'll do is trade out of, if I got running a big position, I'll trade out of the core position, or not, I'm sorry, trade out of, say, the shares that I have outside the core position, because I do trade very heavily. Now, I'm not saying this is something that you guys would want to do. If you just work very slowly and buy a 10% position, on the gap up here, and then add another, say, 10% or 5% here, and you're still sitting there because you have not had any buy points since then. Okay, so these really are your only two buy points: the gap up here, and then the breakout here. So this might be a third buy point, but I'm a little skeptical, so I'll sell into it. Now, I don't have a problem, and this is something that we did at O'Neill all the time. If I sell some in here, if it turns around and goes back up through my price point, I'll just turn around and buy it back. I don't care if I buy it 20 or 30 cents higher, assuming the stock's going to have a bigger move. So, I know a lot of people think that where they bought a stock matters, but I'm always interested in where I bought a stock only in relation to where it goes from there. Whether it's higher than where I sold it earlier, I don't really care. But like I said, I think you're in a little bit funky environment, and it looks a little bit strange to me. So, maybe I'm all wet, maybe it just keeps going. But if it does, I'll just turn around and buy it back. But, if I'm sitting on a core position that's bought down here, you're just hanging out. When I try to get aggressive if I see things start to happen, and I just thought you could get aggressive on this pullback yesterday, and then you get this gift, and that is what, almost a 10% move in a couple of days off the lows. In this market, I found that looking a gift horse in the mouth just gets you a nice spraying of saliva, so I'm not really into it. And I'm sure, Dr. K, you're running a position here, and you're just probably working it the way you usually do.
That's right.
Yeah, and so, so you're not in real heavy. But, if I'm going in 100%, 150% on a stock in here, and it's jamming like this, or I come in and I'm running, say, a 30% position on this pullback, and then I suddenly decide to jack it up to 100% on the pullback and take advantage of that, and it jacks on me, I'm going to back away from that. So that's why.
Yeah, position sizing is everything, and knowing how to deal with your oversized positions, that might be a temporary oversized, is being nimble and taking advantage of days like today. Whereas I've got a normal sized position in this for me, and I'm just sitting in the position, and I use a day like today to add to my position because it's not very big. I want to round it out a little bit further. This is a buy point, and if cores measures out and we get a nice trend, a nice QE trend like we did in QE1 and QE2, then this one could end up, becoming a $90, $100 stock, in the months ahead.
Now, I think here's a good opportunity to teach a little lesson here, Dr. K. So let's say I'm assuming that you bought here, somewhere in here on the gap up here, then you add it again on the breakout, and since then there have been no buy points until today, so you're adding a little bit here today again, right?
That's right.
Okay, now the part that you added here today, would you back away from that if the stock started to break down again?
Well, if it violates the viable gap up, if it starts to go lower and undercut by more than, say, 1 or 2%, then I will end up selling the piece that I bought today. However, I'll keep my core position.
Right, and so that's the way you would handle that, and my approach is a little more aggressive, hyper aggressive, and a little bit different. So, you'll, and I'm comfortable doing that. And obviously, if I can't operate that way, I'm really not that proficient as a trader. When I try to trade the way other people want me to, I lose money, and I had that experience running a fund. And anybody who's gone onto the website, you can see our track records. Dr. Canab audited, I think yours was reviewed by KPMG. Mine was audited by Rothstein Cass during the late 90s. And yeah, I made 11,000% over 8 years, but I had regular drawdowns at 20, 30%, sometimes more than that. But for me, I don't really care. That's, I got deep pockets. I know what I can and can't do, and I know how things are going to work. But once you start running a fund, that becomes, you drop 10% and everybody's losing it. And so I just found that running funds and running other people's money, you get into a situation where you're trying to meet somebody else's expectations. And we've learned more about that as we have run money and started our managed accounts program. And it seems really bizarre. Like some people, if you're down 9%, they're freaking out. And somehow they think that the money they're losing, that you're running and they're losing 9%, that somehow that's going into your pocket. And it's just a weird psychological space to be in. So I've just gotten back to doing things my way in that regard. In terms of the managed accounts that we run, Ross Haber has a very good handle on that in terms of moving very slowly, very deliberately, and trying to keep risks to a minimum in drawdowns as well. Because apparently the public cannot deal with the kind of drawdowns that I'm used to, or even I think you, Dr. K, are used to, correct?
Right. Well, you and I both have had our share of pretty steep drawdowns, and the thing is, we never lose an ounce of sleep over it because we know why. We know why we're having those drawdowns. We know the market's out of phase. And it's going to end. That period, like the 1999, that brief period of 99, that's an aberration. The period we saw in 2012, where the market was like a sawtooth, acting like a sawtooth whipsaw, that's an aberration. And so, again, I don't worry about it. In terms of the market direction model, I don't lose any sleep. And there's nothing to be done about the market direction model in terms of, its core operation, because it's had these periods before. Unfortunately, these periods are rare. But what I like about the VMAPs, like the A and B and C, is that we can dial up, well, on A and B, we can dial up or dial down the risk to suit investors' risk tolerance, and that's what we've done with A and B. So, and it's very now a mechanical process, which should, it should work out very well in terms of investor interest, because then there's no surprises.
Right, and I think if you're using any particular method, you need to understand what kind of volatility is going to be inherent in the way that you size positions, and how big, how big you're willing to go in terms of that position. It's always funny how some people try to turn what is for you a normal drawdown, and they try to turn it into some scandal. And it's just, but they're just morons. So I think there was one guy who created a website. He was a managed account client, and the managed accounts, I think the B program dropped 14%, which is a normal drawdown for the model. And this person, we fired them right away because they started accusing us of ripping them off and all this other stuff. So we just fired them. And then he went and put up some website talking about what I said about something. And I think it's just comical because now those accounts are moving back 5, 6, 7% pretty quickly. And the guy just didn't understand what was going on. But there's a lot of idiots out there, and people, I don't really mean to say idiots per se, but I think most people on this webinar understand that risk and reward go hand in hand. If you don't understand the risk parameters of whatever method you're using, you'll get yourself into trouble. So,
yeah, the problem is when emotions run high, then a lot of logic goes out the window.
Yeah, exactly.
And people react. They end up reacting to a situation that they don't really understand and pointing the finger of blame. Right. And instead of trying to think in it with a cool-headed manner.
Yeah. So it's easier to think that somebody's trying to rip you off rather than that you invested in the system that is going to produce drawdowns from time to time, and it's not a magic money-making system. Anyways, but all that is to say, know thyself. And know the method that you're using, and position size according to what you can tolerate, and understand what you can tolerate. And I don't think any of you would really want me to be running your account the way I run my own, so because you just could not sit through some of the roller coaster rides. In any case, somebody's asking, could RAX be a continuation pocket pivot point today? If it trades higher volume than any of these down days over here off the 10-day moving average, then yes, it would be. Did you short Q-Core on the way down, and if not, why not? Why not? What? That's like asking you, did you beat your wife yesterday, and if not, why not? I don't know. Why not? Because I guess I'm stupid. I should have shorted it. I actually should have shorted Q-Core. If we're going to do this hindsight investing, you should have shorted it.
Yeah,
right
let's stack up all the stocks that have lost 50% or more.
So that means, did you short it on this day? Why not? I don't know. Why would you? Because you're already way down. It's a news thing too, so it could snap the other way on you. So. Remember,
the stock has enough positives in it that you wouldn't want to short this. I mean, it did have a gap up, just on September 4th, and you don't want to be shorting stocks that gap up.
Also, you're not in a bear market, so it's not likely that you're going to be going after stocks per se. You could say it's a late-stage failed base, but I'm not going to go after stocks on the short side here in this environment because it's not really a shortable environment. That's the other reason. How does the wall of worry in this uptrend compare to past wall of worries in other uptrends? Well, I don't know. This one's made out of bricks, and other ones have been made out of cement blocks. I don't know. How does it compare? I don't know. I don't really compare walls of worry unless you show me a couple and I can look at them. But other than that, do you see any comparison between walls of worry in this uptrend versus other ones?
Well, there's always something to worry about, and it's just a different question of what the worry of topic is. I mean, these days it's the recession. The economies are falling apart. They're slowing down. China's slowing down. So that's the worry. And then people are thinking, well, how can companies make money and prosper when the unemployment rate's so high and it's stubbornly high? All these negatives are there. But the one thing, and they were certainly there in 2009. But the one thing that blindsided so many people, and I think including ourselves really in March of 2009, was that the QE effect was so pronounced and so powerful.
Yeah,
and the market direction, that's what I like about market direction model. It actually had a buy signal in March, I think March 12th, 2009, and I ignored it because I was so worried about it. I really, I think we were all so concerned, like what's going to happen to everything now. We've had an unprecedented blow up in the financial system. What's going to happen now? And my model goes to buy, and I ignore it, and yet that was one of the most profitable buy signals.
Exactly. Yeah. Well, we actually talk about that period in our last book. And what my mental state was, having had a hedge fund at Bear Stearns, 2 hedge funds at the time that were at Bear Stearns the weekend that it blew up, and not knowing over that weekend whether millions, tens of millions of dollars had just vaporized on me, and that's a pretty sick feeling. But when you have somebody not even pull the rug out from under you, it's like the whole floor, the ground under you suddenly just evaporates into nothingness. That creates a sense of unease that I've never ever experienced as an investor in my life, and it did psychologically affect me. So, that was one period where the wall of worry created an opportunity, and that people were really shell-shocked. And a lot of people I know got clobbered and killed. And I know guys at Bear Stearns, Lehman Brothers, who had all their retirement money in those stocks. They lost everything. So they went from having $1 million net worths to zero. So somebody's asking why did you think the move in silver would not pan out or gold? Well, because I think that they're way up there. I don't see really any impetus for a big move here, and I just noticed that this is resistance on this high. So what I'll do is maybe sell the high, and if it does continue going, just turn around and buy it back. So it's not really any specific, system or hard and fast method. It's just kind of understanding how these things work, and that they generally will take a few days to go sideways. I also didn't think, because you didn't have a pocket pivot here yesterday, it didn't seem like you were really shaping up to have one this morning, because you were extended from the 10-day this morning, whereas now you've pulled back into the 10-day and you're setting up now potential for a pocket pivot. So, but that's just how I work it. I'm sure none of you guys will work a huge position in AGQ, 100% or more. So I doubt very much if you're in a position where you have to think about that. Tredegar Industries, someone's asking about well, there's no real volume in it today. So it's not really shaping up as a pocket pivot. It's a little bit choppy stock, but you just have to watch that. Let's see. Dr. K, here's one for you. When using the 7-week rule, will you frequently round smaller gains in an effort to find the large winners?
What does he mean by round smaller gains?
I don't know. Not sure what that means. You probably have to state that again. Let's see, another one. Periodically, you cite earnings estimates for stocks well into the future. Where do you find them? We use First Call, but we pay for it. And there's Zacks. I think Yahoo Finance might have some of them. So, but most of the time, you got to pay. Oh, round trip, they said. Okay. Okay, so wait a minute. Will you frequently round trip smaller gains in an effort to find the large winners? I don't know. I don't know what that means exactly. So if I'm round tripping smaller gains to find the large winners.
Oh, you mean in a stock? If a stock's not moving real fast, yeah, I might. I mean, if I'm fully invested, if I'm not too, all the way on margin, and I need to make room for a new stock that looks better, yeah, I will take a gain in a stock that's not moving as fast. I want to force feed my money to the fastest horses at all times in a strong market environment. That means I will sell out stuff that is working just fine, but it's not moving as fast as I'd like it to.
Right.
I did that over and over again in the 90s. That's just the rhythm of it, and I think that contributed hugely to my performance because the money was. My concern was I want every dollar invested in the best stocks right now, every day, every point in time. So I was pretty obsessed about that, and so my turnover rate was extraordinarily high during those years simply because I would the force feeding of money means you're constantly going to be having invested in a stock that's not going to be the fastest thing out there, and you're going to sell it. You're going to sell it at maybe a small profit, maybe break even, and then you're going to move that money into something you believe is going to work better. And if it doesn't, then that money moves out of that stock into something else, and it just keeps going. And extraordinarily high turnover rates in that sense, I think, are amazing because your portfolio, you're maximizing the efficiency of your portfolio that way.
Right. Force feed. Somebody mentions, this is some good information, I think. Coors is pricing Monday night for Tuesday trading. So that's good information. Thank you for that. Somebody says, would you recommend investing in F5 or RU? I think I want to make something very clear here, and this gives me an opportunity. So we don't recommend stocks. Okay, we don't even recommend stocks for ourselves. And I'm going to pull up F5 here. We look for buy points in stocks. Okay, and so if you're looking for a buy point in F5 off of the lows, there aren't any. And the stock had a move up here. It's below the 200-day moving average. It's still in a big, ugly base. There's nothing to invest in here. In fact, for all I know, this stock may just be here's a left shoulder, here's a head. For all I know, it's forming the right shoulder of a Head and Shoulders top. And maybe this is the point where I might want to short it if the market started to roll over. So we don't make recommendations in the sense that, an analyst comes out and says, well, this company is going to do this and that and this, and they got this and these earnings and these sales and their ratios are this, and the CEO drives a Ferrari and all this other, data and information that's kind of useless to us in terms of making a recommendation. Well, we look for our buy points. And so once we see a buy point, we put that out in a report on the website, and you have a stop, and if it doesn't work, then you're out on the stop. So that's really the way we operate. We don't get into recommending investing, and I don't really care much for the term investing. I would say we're more traders in the sense that we let the price volume action tell us what to do rather than trying to come up with some sort of mentality of a recommendation in our own minds. And I think that's the soundest way to go, because I can tell you at the peak of March 2000, after the dot-com bubble, remember that, Dr. K? A lot of analysts were coming out and raising price targets on stocks to the moon.
Yeah, Qualcomm 1000.
Yeah, and all those recommendations, turned out to be for naught. So we operate on price volume action. So right now, RU, this isn't a base. This one's better than F5, but it's not something I would recommend investing in. It trades 230,000 shares a day. That's really thin. I think, is RU a retail? Yeah, apparel shoe company. 16% earnings growth. Ask yourself this. Would you rather own RU, which has 16% earnings growth in the most recent quarter, or would you rather have Coors, which has 162% earnings growth in the most recent quarter, and before that 133% earnings growth, and before that 87% earnings growth, before that 188% earnings growth, and before that 117% earnings growth, whereas RU last quarter 16%, 21, 18, 21, 19. I mean, this is a 20% grower, okay, pretty steady. not bad for a retailer, but if you're really looking for that upside pump, I think you're looking for better fundamentals, and I think a stock like Coors is much more desirable than a RU. So, and think about stocks that way too. You know, do you really want to own a company with just a few percent earnings growth and sales growth, or do you like something like Coors, which is 71% increase in earnings, which is the highest quarterly earnings growth that I can see on my system right now, and that was in the most recent quarter, you know. And they're running another way to kind of you know, look at things. Coors has a 56.2% return on equity, so that tells you management there, it's well managed, they do a good job, and it's a very profitable company. Whereas RU 21 has, you know, they're not too bad, 31.2, but you know, comparing apples to apples, in this case, I think it's really apples to oranges, and I think Coors is the one to go for on all fronts in terms of fundamentals. So that's one way to sort of sift through these. In my view, profitability, and just when you got that big triple-digit earnings growth that is accelerating, that's really where you want to be. So if you're looking at, say, a retail stock like RU versus Coors, you want to go with Coors. I've thought New Skin Enterprises is short. Somebody's asking about this. The only problem is I can't. It's too thin. I can't borrow it, and but that's one heck of an ugly pattern there, and it's breaking down. So I kind of tend to want to look at this as a on a rally if I was going to short it. You know, Herbalife, same thing here. You know, great head and shoulders pattern. It's breaking down. You know, these could be shorts, but you're noticing how it's undercutting this low here. So right there is the low. It's undercutting it. I would look, if you wanted to short it and the market starts to come off, you could look for a rally back up. So, but HLF tends to be very news-oriented. One of the stocks that I've actually hit a couple of times on these breaks is Cerner, and I think that's kind of an ugly-looking pattern. There's a left shoulder, a head, and a right shoulder, and now you're rallying back up to the 50-day moving average. I'm kind of keeping an eye on this one. This is on my list. NetEase is another one I've been watching. Same sort of situation here. Kind of a couple sloppy left shoulders in here, a head, breaking down here, and probably you might say this is more like a big head. And you're kind of failing here at the 50-day or the 10-week moving average, and so that looks like another one that could potentially be shortable here. And I kind of like this position after having found some resistance here. But again, I want to do this only if the market's coming off. So we're getting up to the end of the hour. Why have rules and you're going to not use them in Apple? Why have rules? Why do I need to buy Apple? You know, like I said, what's so exciting about Apple versus some of the moves we've seen in, say, Onyx or Coors? You know, a move in Apple from 620 to 700 is a little over 10%, okay? If you're buying Coors on the Bible breakout at 48, you're up a lot more than, but you're up about, what, 15% there, Dr. K, is that about right? So, you know, you get better juice out of other stocks than Apple. You know, right. I don't know. And I guess, you know, I have to be a little smug here. You know, buying Apple seems so uncreative to me. Do you have an upside price target of PCRX? No, because I don't own it, so, but no idea. And I wouldn't really rely on upside price targets. I mean, those give us some idea where a stock could go, but in general, we're relying on the 7-week rule to tell us when to sell a stock. I like somebody's asking about Ellie Mae. I don't know. I think of this hot blonde in these little cut-off jeans shorts whenever I see that stock. I don't know if it's just me or what, but you know, whereas Nation Star Mortgage is actually doing better here. Let's see here. Come on, eSignal. You can bring the chart up any day now. Somebody said I need to get the new version of eSignal. I saw a new version of eSignal, but it's got a totally different layout, and
I don't like it.
I don't really like it at all either. And the charts, I can't set up the charts the same way. So, you know, they kind of did like an O'Neill thing to me. It's like they over-designed it and didn't really think about the utility that it already had. With both of these stocks, you know, I don't know what the heck is going on here. There we go. I don't know what, you know, my eSignal, it seems like the last couple of webinars we've done, towards the end of the webinar, my eSignal is kind of pooping out on me. But you had sort of a big pocket pivot, and these are moving. You know, they're both moving, but Ellie's more in a better position here on this pocket pivot, but these stocks both have had big moves. And if you look at, here's the weekly on Ellie, that's had a big move, and NSM, Nation Star has had a big move too. So I'm not really buyers here. The current administration says the economy is fine. Nothing to see here. Move along. Yeah, I don't know what planet those guys are living on. But like I said, I consider all politicians to be liars. And I myself am a libertarian. And for those of you who know nothing about libertarianism, libertarians really, that name came after the 1930s because before that it was known as classical liberalism. And the liberal was somebody who believed that the individual's freedom was of primary importance and that the government really had no say. And that actually delves into a lot of different sides with respect to the issues. Gay marriage, I don't think that's the government's business, and I don't really, if I'm against gay marriage, well, I'm not going to have one. The drug war, I think, is a completely stupid waste of money. Trying to be world policemen and spending all of the money there, I think, is stupid. Taxing people in excess and thinking that even though you're already paying 50% of your income in taxes, that you still need to pay your, quote, fair share, while half of the country doesn't pay any taxes, I think all of that just speaks to the freedom of the individual over the state, and that's what libertarianism is about. So I don't really care for Republicans or Democrats. For those of you who would like to email us and describe me as some sort of a right-wing gun nut or something like that, I am a gun nut, but I'm not a right-wing gun nut. I'm sort of a two-wing gun nut. But I don't really care for any of them. I think they're all liars, and I'm questioning whether even Mitt Romney has the ability to fix the problems in the country. And so, even if he does get into office, you have to consider the fact that the Tea Party is considered radical simply because they want to diminish government spending growth. In other words, the growth of government spending down to about 1.5% baseline growth, which means it's still growing, it's still increasing. But just because they want to slow it down, they're radicals. So it just tells you where the whole system is at. Anyways, thanks for that, Jim. You gave me the opportunity to go off, and I took it. Source fire, I'm not a big fan here. So it's building a base, though, so you just keep an eye on it. But there's really no buy signals here. Drifting down probably more than you would want to see for a handle. That's kind of deep and very loose, ugly kind of pattern. Going to try to get through some other ones. SSYS, I think, Stratasys, both of these stocks in this group, Triple D and SSYS. Dr. K and I never really liked them, especially Triple D, because they're just kind of erratic. And I think this one is similar, and it broke out, and you had a pocket pivot in here, but it isn't holding, and it's violating the 50-day moving average. So I think if you own the stock, you're gone. Am I right, Dr. K?
Exactly.
GPS. Somebody asked about, is it CG? What about CG? Carlyle Group. I don't know. I'm not a buyer. Don't like it. No buy points. No volume. Nothing here going on here on the way up. That's an ugly pattern.
Too slow. No earnings. Or reduced earnings.
GPS Gap Stores is acting well. Most of the retailers are acting well. Again, I prefer Michael Kors, but it's acting okay. But there's no other buy points. You got a pocket pivot here. Then some heavy blowing here, it goes nowhere. So it's acting okay. So it looks fine. It's like, I think Ann is doing the same thing. It's acting okay. It kind of flits around the 10-day. But these are all, the retail group in a number of areas has been strong. We've talked about Ulta Salon, someone's asking about, but Hain is starting to flitter around the low of this Bible gap up, so it's looking like a little bit of trouble there. Hope you didn't get one of those tungsten-filled bars. No, you don't get those if you buy them. Gold bars, you make sure you buy them from a legitimate source. Credit Suisse would be a good place. That's where I generally look to buy gold. So, but if you don't believe, you can always saw them in half and check out what's in the middle of them. Keep us posted when you go on Barney. I'd love to watch your ability to out-debate him. Well, Stewart's a pretty bad investor. I mean, the guy sits there on Microsoft, and he says he's investing in Microsoft. It's like, if that's investing, then I'll be a trader any day. Ryland, the builders continue to go higher, so not much to show there. All of them, D.H. Horton, Lennar, they're all going higher. Okay, so the shuttle lands around 11:30 a.m. I can actually run out there and see if it comes in. Someone's asking if Culver Boulevard. Our office is actually on Culver Boulevard, right where it runs into the beach, and I think they're going to bring it up Culver Boulevard all the way into South Central. Dr. K, the VIX trading model has risen from the dead. Shorts seem to work far better in UVXY, TVIX. Understanding big money keeps us short on these boys with out-of-money calls to protect against spikes. Do you get that one?
It sounds just like a statement, but yeah, the model is, it's working as it should, and it should normally switch a lot more frequently, or I should say more frequently than the market direction model. But
Yeah.
right now we're in a very sweet spot. The ducks are in a row, and we're in an uptrend. So in that sense, the UBXY TVIX model could potentially sit on its signal for as long as this uptrend lasts.
Yeah. Dr. K, are you using the 7-week rule now for GLD on the 10-day moving average? Has it been up above the 10-day for more than 7 weeks? I don't think so. Let me see. Maybe it has.
Let me see here. From the buy point,
I don't think.
no, it hasn't reached 7 weeks yet.
No. Okay. Somebody says, why do we have to wait until January 2013 for the new book? I'll tell you something, a little inside info here. When we first started writing the book, I do all the charts for them, and I started doing them in black and white, because the first book we did them in black and white, and I do all the moving averages and the up and down days and different variations of grayscale. And when I started doing that, they told me, no, go do them in color because we're going to do an enhanced ebook. And apparently that went out the window. So what they were going to do is convert the color charts into grayscale, and as it turns out, they're not coming out too good. And so some of them, we're having them redone and having them work on them to make them look right. So in about 2 weeks, we're supposed to get, or within 2 weeks, we're supposed to get a hard copy PDF of the book. That will be our final chance to review it. So I'm interested to see what the charts look like. Now, if they're not up to snuff, then we may have to go back to the drawing board and redo them all in black and white, which I was going to do in the first place. So I don't know, I think we should have done them that way. But that's just the way it is, But yeah, I do hear though that we may have the book out by October. But they're saying January just to be safe. This is a good idea, I think. Have you considered making these webinars available via a more portable format, say MP4 for listening on iPad, or on a disconnected basis? Now, Dr. K, there's your iPad app right there, a webinar viewer.
There should be apps already that take we post these on YouTube, and you should be able to use a Firefox app to convert it into an MP4 format or whatever format you want, and then you can throw it on your iPad or your iPhone, whatever you want.
Yeah, we'll have to look into that. And
there's so many apps out there that generally is going to be an app for something like this, because it would be a very basic type of a utility that people would find useful.
All right, here's MasterCard. Somebody's asking, you got a pocket pivot right there? That's about it. So I guess if you like it, you could buy it. The new book should be available on Kindle. I believe it should be.
Yes.
I think we're over. It's 10:09 now, so we're going to have to cut it short. I'm going to finish off with one last stock here. Actually, we'll do two last stocks. WPI, here's the Bible gap up, still holding up, but it's just slow-mo, so nothing really going on. Somebody's asking, how do you assess the very low volume as it has moved to new highs? Would you expect an inflection point where big institutions or Ross make a volume spike? I don't think Ross owns this one right now. I don't know, it's just not getting a lot of volume. To me, it's not a really exciting stock, so I'd rather own Onyx Pharmaceuticals. But last but not least, Mellanox, I hate this stock now because it did force us out partially here and then out of the whole thing here. And, of course, it does find support along the 50-day moving average and is moving back higher. That'll happen from time to time, but you can't risk the possibility of the stock continuing to break down. I mean, it's not really going to, if you're running a 20% position, you drop 10 or 15%, it's going to cost you 1.5%, 2%. I think that's what we ended up eating on it. But I'd rather keep it to that than getting tagged for a good 10% if it really blows apart. And that's a lot of selling right there. But you're not getting any buy point off the 50-day moving average, so we're not going to re-enter this thing. We're going to wait. So somebody says Endeavor flying low over Sacramento now. What's up with that? What I want to know is how much money is it costing them to do all these veering off to different places like Arizona to spin around for posterity or whatever the heck they're doing. Do they understand that the country has a massive deficit? I don't get it. Anyways, I think that's all we have. Save your questions for next time. So I will say, though, Kihu I don't really care for. It's a cheap little Chinese stock. And we already talked about, what's that, 5? Yeah, I don't really like this one either. It's really thin little stock. So kind of wild on the weekly chart, so don't really care for those. Anyways, a lot of questions today. Sorry we can't go for another hour and a half. Somebody's asking me, do I like Seadrill? No, I don't like Seadrill. And I think that's pretty much it. There are a lot more questions, but we really can't get to them all tonight, or this morning rather, tonight. Boy, I'm really getting ahead of myself. All right, so that's really all we got. So you're kind of moving sideways. Not a heck of a lot to do here. Maybe a couple of buy points with cores, with Expedia, but we're more inclined to hang tight using the pocket pivots or the prior buy points to hold on to our core positions. You got anything else to add, Dr. K?
No, I think we're good.
Okay, and just one last point. Someone's asking about all this, O'Neill adds to stocks when they're up here and they're up there. We don't do any of that, and he adds 5% if you go up 2% or 10% if you go up 2%. I don't know. To me, all of that is inexact and kind of silly. We just prefer to operate on the basis of buy points when they show up and then using those to add to our position. So it's just very disciplined that way, and it keeps you out of trouble. I don't really care much for that whole system. Do you, Dr. K?
No, not my thing.
So anyways, on that note, thanks for showing up, you guys. I hope we've helped add some clarity to what is really otherwise a relatively benign and kind of blah market, and we'll just kind of see where we go next week. All right, so hang in there. We'll catch you guys later. Take care.
So long, everyone.